If you're watching this video, chances are you've asked yourself, I've already maxed out my 401k, what should I do next? First of all, congratulations. That's a huge milestone that will put you ahead of the curve financially. But don't just stop there. In this video, I'll walk you through the smartest ways to use your next dollar, strategies that are tax efficient, flexible, and aligned with your long-term goals. And before we get started, my name is Ryan Knoll. I'm a certified financial planner and founder of NAV Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. For 2025, the contribution limit for most people is $23,000. If you happen to be over the age of 50, that number increases to $30,500. That's not including any employer match that you receive. So when we say that you've maxed out your 401k, we're referencing that elective deferral limit, or what you can contribute via the tax advantage of making a pre-tax contribution to your 401k. And once you've hit that number, the question becomes, where should you put your next dollar? And that's exactly what we're going to cover in this video. But the first thing we need to do is we need to go back and revisit your financial plan. You need to make sure that you're on track to hit your other goals. And if you are, now we can begin deciding how to effectively allocate this money moving forward. So before you jump into the next account, zoom out and ask, am I on track to retire when I want to? Can I afford to take my foot off the gas? Are there any short or midterm goals that deserve more funding? Things like traveling, a second home, retiring early, or maybe sending one of your children to school. If you're ahead of schedule or on pace to hit all of those goals, your next move might not be to save more. It might actually be to live more. But if you are trying to build more wealth, here's what I would look at next. So after you've had a chance to take stock of your financial plan, the next step is just to pay down your high interest rate debt. And this isn't flashy, but it is smart. And if you're capable of maxing out your 401k, chances are you've likely already done this. But I sometimes see investors so focused on saving and investing that they forget to knock out the low-hanging fruit. So if you've got debt charging you 8, 10, 12, 20% interest, paying it down gives you a guaranteed rate of return that's likely better than what you would get tax adjusted through the market. Credit cards, personal loans, or even car loans over 6 or 7%, knock those out as well. Doing those things maximizes a couple of things for you. The first is it maximizes your rate of return. Paying off a 10K loan that's at 12% interest is a guaranteed 12% interest rate. I would take a guaranteed 12% interest rate any day of the week. The other thing it does is it increases your cash flow once the debt is officially paid off. You can save yourself hundreds or even thousands of dollars in the way of monthly payments, which can then be funneled towards your investment accounts. On the flip side, if you've got a mortgage locked in at something like 3%, don't rush to pay that down unless the emotional payoff is worth it. Over the long run, you will likely earn a rate of return greater than 7% by investing in a 100% stock portfolio in the market. But if you've gotten to this point, sometimes the peace of mind of being debt-free is worth a little bit extra in your investment account. Only you will know, but both approaches do have merit, so consider each and decide which one makes the most sense for you and your family. So the next step is to make sure that you utilize your HSA, assuming you have one available to you. So if you're enrolled in a high deductible health plan, you're eligible for an HSA. And that's the only account that's triple tax-free. It's tax deductible going in, you get tax-free growth, and then your distributions can be tax-free as long as you utilize them for qualified medical expenses, whether that's today or in retirement. In 2025, the HSA income limits are $4,300 for individuals and $8,650 for families. There's also a $1,000 catch-up contribution that applies to individuals who are age 55 or older. You want to use this as a stealth retirement account. Pay for your medical bills out of pocket today if possible, and let your HSA grow. Then reimburse yourself tax-free years down the road. I'm also encouraging more and more clients to utilize their HSA as a long-term care funding account. And you have two ways you can use these funds to help fund a long-term care event. The first is you can explicitly pay for the expenses tax-free if you incur a long-term care event. In other words, you sock money away today and you let it grow for decades. And if you say, let's say you need $10,000 during your retirement to cover your long-term care event monthly, you can pull that money out tax-free to pay for those expenses. Now, you can also utilize an HSA to help fund long-term care insurance premiums. Now, there are some annual limits you want to be aware of as to how much you can pay for the premiums directly from your HSA, but this is a great strategy to get the leverage of insurance to further amplify your ability to pay for a long-term care event. So for someone between the ages of 50 and 59, you can utilize your HSA to pay for about $1,800 worth of premiums a year. And if you're 60 to 69, you can utilize nearly $5,000. So this is money that goes tax free to pay for another tax free benefit in the way of the insurance that'll help fund or completely fund your long term care event should that happen. And statistics show that if you are a married couple, either you or your spouse is likely to have a long term care event in your lifetime. So this is something that is a huge burden on many people's retirement plans that needs to be talked about more because I've seen it really derail some clients' retirement plans who weren't properly prepared for this type of situation. So now that you've decided whether you're going to pay off debt or if you've already found that you have paid off your debt, step 4 is investing in a Roth IRA. And in 2025, the contribution limit for a Roth IRA is $7,000. And if you happen to be over the age of 50, that limit's $8,000. The catch here, though, is income limitations. If you're a single tax filer and your adjusted gross income is over $146,000, part or all of your Roth IRA contribution will be phased out, meaning you can't do up to that limit. If you're married and filing jointly, that limit is $230,000. So just something to be cognizant of depending on where you fall from an income perspective. So if you qualify, that's great. This is one of the most powerful accounts you can have for your retirement strategy. But if you don't qualify, don't fret. There's still a way to get the money into the account. You want to utilize something called a backdoor Roth IRA. And any good financial planner and CPA will know how to file this correctly for you so you don't create a tax headache and you're still able to reap the rewards of having a Roth IRA. Now, the one thing you want to be aware of is the pro rata rule. If you have both pre-tax and Roth dollars and IRAs held separately, some of your backdoor Roth IRA conversion may become taxable. If you find yourself in that position, I encourage you to check out my video on the pro rata rule. This will walk you through what it is and how to get around it legally and tax efficiently with as few implications as possible. The next step in this is a big one, but only if your 401k plan allows it, and this is the Mega Backdoor Roth 401k. And I purposely keep this a little lower on my list than other advisors because sometimes having a little bit more flexibility with how your money is invested is better than maximizing for tax deferral. But let's say this makes the most sense for you. Let's go over a little bit about how the Mega Backdoor Roth would work. So after you've maxed out your standard contributions, some plans will allow you to make non-deductible contributions up to the 401k limit, which is $70,000 for 2025. If you happen to be over the age of 50, it's $77,500. Now, if your plan allows for what's called an in-plan conversion, you can roll these after-tax dollars into your Roth 401k or Roth IRA, creating what is known as the Mega Backdoor Roth. This move can potentially add tens of thousands of dollars to your lifetime retirement portfolio by taking advantage of this tax loophole. So let's go over a brief example of what exactly this would look like. We'll apply some numbers to help you walk through this in your own situation. So let's assume you're under 50. And we know if you're under 50, the upper limit for what you can contribute to a 401k is $70,000. So let's say you max out your pre-tax deferral at $23,500 for 2025. And let's just assume, to keep the math real simple, that your employer does a $6,500 match. So you've essentially put in $30,000 between your pre-tax deferral and what your employer has put in for you. Now, we know that the upper limit's $70,000, so you have an opportunity to contribute another $40,000 to that 401k plan. That $40,000 would be made as a non-deductible contribution to the traditional bucket of the 401k. After you make that contribution, you want to immediately convert that $40,000 to your Roth 401k or your Roth IRA. The reason you do this is all of the growth will then be tax-free and then be distributed tax-free to you in retirement. So essentially, you're overfunding a Roth account with a huge amount of money that will then be distributed to you or your beneficiaries later on, completely tax-free. And that's what makes the Mega Backdoor Roth 401k option so attractive. Okay, so let's go over a brief example here. Let's say that you're under 50 years old and you plan to max out your pre-tax deferrals for 2025. So that means you can put in $23,000 pre-tax into your 401k. And let's assume that your company match is $7,000. So you've effectively put in $30,000 total. But we know that the overarching limit on 401ks is $70,000. You've put in 30. What do we do with this other 40K? And that's the big question. And this is the big opportunity that we have inside of an employer-sponsored plan where they allow for a Mega Backdoor Roth. So the Mega Backdoor Roth would say, we take this 40K and we make a non-deductible contribution. And then we immediately convert this to Roth. So you have $40,000 in a Roth account. And because this was a non-deductible contribution, there's no tax implications for doing this, assuming it's structured appropriately. This money then is in a Roth account where it can grow tax-free and be distributed tax-free, earnings and principal combined. This is a huge advantage for somebody who has this option within their 401k plan. Now that you've maxed out your tax advantaged options, your next best bet is to build a taxable brokerage account. And here's why. There's no contribution limits. You have full liquidity to use the funds for whatever you want. Travel, a new home, a bridge between early retirement and 59 and a half to help fund your lifestyle. You also have long-term capital gains tax treatment on any security held for a year or more, and you can utilize potential tax loss harvesting strategies. Sure, it's not tax sheltered like an IRA or 401k, but it offers much more flexibility that the other accounts can't match. This is ideal if you're on track for retirement and want to build wealth with freedom. This is also where you want to be a bit more strategic with your investments. Tax-free investments like municipal bonds make a lot of sense here, as do investing in securities with smaller dividend yields so as not to realize more income than is needed throughout the course of a year. You also want to be wary of mutual funds and the tax implications for their capital gains distributions. For a more in-depth look on how to avoid brokerage account pitfalls, make sure you check out the YouTube video I made going over the biggest brokerage account mistakes I see investors making today. Sometimes the best return isn't financial. Have you ever wanted to go back to school, start a business, or take that trip you've always been dreaming about? If you're on track, using your next dollars to improve your quality of life can be just as impactful, if not more impactful, than growing your net worth. And these are often the most rewarding dollars I find my clients spend. So there's no one-size-fits-all answer as to what's the best thing to do with your next dollar. But here's a quick recap of your options now that you've maxed out your 401k. First and foremost, make sure all of your high interest rate debt is paid down. Next, take advantage of a Roth IRA or the backdoor Roth IRA if you're subject to the income phase-outs. Third, the HSA is the only triple tax advantage account that you have at your disposal. Making sure you're taking advantage of it allows you to have a upfront tax deduction and tax-free income later on in life if used for a qualifying medical expense. The fourth option is to make sure you're taking advantage of your mega backdoor Roth 401k option if it is available through your plan sponsor. Fifth, tap that brokerage account to put any ancillary savings in there that's not subject to when you can pull the money out or have any timing constraints to it. And then sixth, reinvest in life, maybe start that new business, or just in the freedom that you can have the ability to spend your money on what you want to not have to worry. The best move, though, is one that aligns with your goals. And if you're having trouble figuring out what that is, talk with a financial planner to help. If this video helps you, please subscribe to the channel and share it with someone else who's asking the same question. What do I do next? Remember, money is just a tool to help you live the life you want. There are certain ways to maximize your money, but if you find you're on track to hit all of your goals, sometimes using it for what you want is better than maximizing for every last dollar. Thank you so much for watching, and I'll see you in the next video.